This isn't as long as it seems, and there are some external videos in it, so relax. A very common myth is this idea of too big to fail. How would you respond to that based on what you've learned so far? Take a minute, write down your ideas before you proceed. Another relevant concept is disposable income, which is your income after taxes and deductions. This is what goes into your bank account, into your wallet or purse. And this is what's available to you to either consume or save. All right. Now, when we say disposable, it doesn't mean like it's disposable cup that you can throw it away. Oh no, don't do that. Have you heard of something being at your disposal? If it's something at your disposal, it means it's available to you. So it's the same thing. You might want to highlight that. Or think of the French disponible, right? Same idea, all right? Now, we have a couple of, now that's cool, a couple of formulas for it. Disposable income is your gross income, which is the same as the GDP. Remember, G is for gross, right? Everything, so this is the opposite of, disposable income is the opposite of the accrued income because you are taking out the taxes and deductions. And what do you do with that? You can either consume it or save it. So we have two formulas for disposable income. Both of them are very useful. The first formula is about where it comes from. It comes from the total income minus the taxes and deductions. The second formula is for where it goes into. It goes into one of two things, either consumption or saving. So I'm going to give you some practice here. You're given your gross income and the deductions and taxes. You have to find the disposable. And then you're told that you save 10% of that, so you have to determine the saving and the consumption. And you're told that your disposable income doubles, other things being equal, so you still save 10% of that. So you tell me your new saving and your new consumption, all right? So you have to use the two formulas you're given for these questions. So pause here, take your time, write down the formulas, write down the definition, and also do the problems. Wow, that was cool. So the essence of savings are things that you put aside for future, and that would be something that constitutes your wealth because of confidence, because of security. Okay, so we can have a simple table contrasting consumption with saving. Consumption is basically when you use your money today. Saving is when you use it tomorrow. And you can see there is an opportunity cost between them. Remember the whole thing between short run, long run? That's one good example of that. All right, now if people feel more secure, okay, what's going to happen to their spending? What's going to happen to their saving? Okay, so you can guess that the consumption is going to drop and the saving is going to increase because they have their security need met. Here's another useful table contrasting investment in its economic sense with saving. So investment is always by firms as opposed to saving, which is by household. So whatever you guys do would be a form of saving. All right, investment has an element of borrowing as opposed to saving, which is really the same as lending, because when you save your money, you're lending it to someone else. That's why in investment, they have to pay interest because they're borrowing, whereas in saving, you will earn interest. All right. Investment is what's going into production, whereas saving is not directly going into production. So saving is not part of GDP, whereas investment is. All right. So let's look at an example here. Let's say you're investing in stocks or investing in the bank. So these are, I put it in quotation marks because these are terms that we use in everyday language. Would that be investment in its economic sense, or would it be saving? If you look at it, if you look at the two columns here, you can easily match the example given with saving. Another similar example would be buying stocks or depositing or saving in the bank, right? All of them are examples of saving in its economic sense. Okay. Now, what does it mean when you buy stock? Buying a stock basically means buying a share. It's kind of like buying a brick in the company. Have you heard of shareholder? That's what it means. All right. So it is a form of ownership. It's a transfer of wealth. And that's why it's not part of GDP, because it's old stuff. It's something that was already included in the previous years. All right. So saving is a source of funds for investment. So eventually saving becomes the funds that the companies borrow in order to put in their business. But what I want to clarify here is that whenever in macroeconomics you see investment, it is by firms and it's a form of borrowing. I want to emphasize that because you're going to see questions related to interest rate and you have to think of borrowers. So pause here, do a nice table for yourself and take some notes. Try to use your own words. The business cycle looks like what you see here with these wavy ups and downs of GDP. So you have GDP on one side and the time on the other side. So these are the fluctuations in the short run. Remember, in the long run, we call growth, which is the overall trend of GDP. So expansion is when GDP goes up. It's also called boom or recovery. The opposite of that is recession, which is when GDP goes down for 2 consecutive quarters, so for half a year. And there are a couple other names for it. The maximum point is the peak. The minimum point is the trough. If you've done physics, these are terms that are used for waves. So take some notes on the definitions here and also do a diagram for yourself. You don't need numbers, but just have the overall shape and the different segments of the graph. Have you heard of the Great Depression? That would be a very severe recession, and that happened in 1929, and it lasted for almost 10 years. In the stock market, there are some equivalent terms, and we use the bear versus the bull market, all right? Now, you might be like, hang on, where did the names come from? I honestly don't know, but one explanation is that the bull is very active, whereas the bear hibernates, right? So another explanation is that if you're attacked by a bear, it's going to put you down. If you're attacked by a bull, it's going to throw you up. Whatever, take notes. Let's compare a contraction with an expansion. The determining factor in business cycle is GDP. If you're in a contraction, the GDP is low and below potential. If you're in expansion, it's high. Can you guess what's going to be the employment level during a contraction? If you're not making much goods and services, well, we have low level of employment, which means high unemployment. Otherwise, we're going to have high employment, which is called full employment or overemployment. And that explains how you can be above potential by overtime. What do you think would happen to the investment? And remember, investment is by firms, right? What would the firms do if there's a contraction? Things are not promising, so they're not going to invest much. So they're like, what a mess, I'm not going to invest. Whereas in an expansion, things are very promising, so they're likely to invest more. Now, there is an exception here, and those are entrepreneurs. Do you remember creative destruction? You might want to check your notes. This could be a test question. How do you explain the behavior of entrepreneurs during contraction versus expansion? And your tip is that that would be an exception to what we have here. And you have to use creative destruction to explain that. What about politicians? When there's a contraction, the politicians would be unpopular because everybody is going to blame them. Whereas in an expansion, things are popular because there are high jobs, many jobs, and high incomes, right? Except for the opposition. The opposition party is going to blame the current government during a contraction, so they're going to use that in order to say, hey, vote for us. Look at the mess that they made. What have you done? You know, all of that to win the votes, right? Anyway, as if they're going to fix it. Simple rule of thumb here is that production and jobs go hand in hand. So more production and more jobs go hand in hand. Less production and less jobs go hand in hand. Pause here and take some notes. You're going to love this. I'm going to give you some images to learn and remember this mess better. Think of contraction as being sleeping and expansion as being awake. Think of contraction as being ill versus being well. Being cloudy versus being sunny. All right. Now here's a question for you. Is it natural to have these stages and these cycles? Yeah, naturally in life we do sleep and we wake up. We get ill and we get well, right? So the idea is that even though it may not be very pleasant, it may not be as productive, some of these things, they are natural. So what I want you guys to get is that these are natural part of the process. We must accept that there are cycles in life and they are not completely avoidable. So a major fallacy is when the government tries to smoothen out everything and avoid all fluctuations. It's not feasible, and often it creates other problems. So here's another diagram which shows you the business cycle, and notice that the blue line shows you the long-term growth. So we're going to compare the growth versus the business cycle. So you can think of the climate versus the weather metaphor between them. So climate is kind of like overall in the long run, whereas the weather is more volatile. It's about predictability. Growth is much more predictable. And what happens is that here you have technology and human capital. This is more about confidence and speculation. And oh, that's cool. Something to emphasize again is that business cycle is a natural part of the process. So you can think of it like this: growth is when you zoom out. Business cycle is when you zoom in. Or you can also think of the macro versus micro distinction. So growth is a little bit more of a macro view. Business cycle is more of a micro view, although it's applied to the whole economy. You can also think of a relationship. Things aren't always steady. There are ups and downs, all right? So think of the examples you saw in the last slide and here, and do some drawing for yourself, like sleeping, illness, whatever. before you proceed so that you can have an image in your mind. The Great Depression of 1930s and the Great Recession of 2008 were examples of financial bubbles. One cause for that is when the central bank keeps the interest rate too low. And remember, interest rate is the cost of borrowing. So it's going to be extra borrowing and extra investing in the economy, which creates the bubble. Another factor here is the human psychology, which involves some level of overconfidence, where we think that a certain asset like stocks in the 1920s or housing in the early 2000s are going to boom. So what we're going to do is we're going to invest a lot in it. But that becomes a self-fulfilling prophecy. Because what happens when people are optimistic about something, the investors are going to borrow a lot to put into it. But as they buy more of it, it creates an artificial demand for it. So the price of it goes up. Whenever there is too much demand for something, the price goes up. The price goes up not because it's actually valuable. The price is only a reflection of the speculation of the investors. So the investors are going to be like, see, I told you it's going to go up. See, I told you, in the same annoying way, which is going to just trigger even more and more investments in it. All right. But the borrower, the lenders are also following what the borrowers are doing. They're following the market. And at some point, they're going to become suspicious that the borrowers may not be able to pay back their loans because they are over-investing. So the lenders are going to call back their loans. And that's going to collapse the whole system. It's going to create a chain reaction. The bubble bursts and the domino effect will ripple throughout the economy. So everybody will be in a mess. Now, there is that human psychology element here, like the greed and all that, but the real trigger of it all is the low interest rates. So always, whenever there has been a financial bubble, there has been some intervention by the central bank to artificially lower the interest rate. If they don't fiddle around so much with micromanaging things, we wouldn't have financial bubbles. This is a very cool concept which was developed by Austrian economist Joseph Schumpeter. Whenever things go down, the first businesses to close are the inefficient ones, thereby opening room for new opportunities to pick up the slack and employ the resources. So the old light bulb breaks to give room to a new one. It's a form of spring cleaning and nothing to be afraid of because it's an improvement of efficiency. So think of some of the recent companies in the past couple of decades which have really boomed a lot. And they have boomed a lot at the expense of other companies which have gone down, such as print media, pulp and paper, and some manufacturing. All right. Another good example is think of a phoenix. It burns, which is painful, but then it will rise again from its own ashes. Or think of a forest fire. Again, there is a burning, there is a destruction, but it clears the way for new trees to grow. All right. So if you think in terms of short term, there is a cost to pay, but in the long run, it's an increase in efficiency. So pause here, write the definition down and also write down your own example of it, like the phoenix or the forest fire, or if you want, try to do a nice drawing which helps you retain the material. Nice, origami. There's this notion that automation kills jobs. And let's look at some examples here. Think of telegram and traditional mail. With the advent of email and cell phones, some of these jobs were lost, whereas new jobs were created. All right. Or think of the example of carriages and rickshaws. With new transportation, again, some jobs were lost and new jobs were created. Think of manual cleaning. With the new technologies, a lot of these jobs were lost, the old models, and new ones were created. Now here's a question for you. If you had the option to live either in the old system with the old type of jobs or in the new system with the new technology and new jobs, which one would you choose? Where is life more convenient? We're going to look at this a little bit further, but you can think of other examples too. Anything manual versus automated, so like lamps versus new lights. One thing that I want to clarify is that technology does kill certain jobs, but it also creates other jobs. Another thing is that job in and of itself is not valuable. What is more important is the type of job. All right. So just saying that something kills jobs or destroys jobs, that's not enough to draw a conclusion. You must have a little bit more nuance. You must ask what kind of job is being destroyed and what other kinds of jobs are being created. Just because there is a job being lost doesn't mean that something bad is happening. So the question is technology labor saving or labor augmenting? It must be admitted that there are certain kinds of jobs which are lost. But what are those jobs? These are usually unskilled, manual, unpleasant jobs. That was so cool. What are the kinds of jobs that are created with technology? More skilled jobs, more specialized, which means also higher pay for the workers. But also, you shouldn't just look at the workers. You should also look at the whole economy, including the consumers. So the consumers also benefit because the cost of living goes down for them because of technology, and the convenience goes up. So overall, oh, nice. Overall, the standard of living tends to go up and efficiency goes up with technology. Wow, that was cool. Remember what's a recession? When the production of goods and services is very low, which means that there is no demand for labor and that creates unemployment. As opposed to an expansion where the economy is too heated, so there are many goods and services produced, which is going to exert upward pressure on the prices. So in one case we have unemployment, in another case we have inflation, both of which are economic evils. And also we have instability when there is ups and downs, the boom and bust. We don't like that, right? We're like, oh no, what have you done? So there was this brilliant economist, British economist, John Maynard Keynes, who came up with an idea during the Great Depression. So something important, guys, is that to understand a thinker, you have to understand them in their historical context. So he was speaking during the Great Depression where everything was low. All right. So his proposed idea was that the government can fix economic. That was so cool. That the government, he believed in the government's ability and responsibility to fix economic problems. And as you can see, this is being pretty demanding on the part of the government. He's basically asking the government to do a lot. He was very influential. He was one of the most influential people in the 20th century. And fiscal policy, which we're going to see, was basically developed because of his idea. He's really the father of macroeconomics. But we're going to also see that his ideas had a lot of problems because asking the government to do a lot of things has its own problems. All right. But before we move on, I want to clarify how to pronounce his name. This is Keynes. So think of this. What is that? That's a cane. All right. And then make it plural. What do you get? You get Keynes. All right, so that's how you pronounce it, Keynes. Say that a few times because there are some people with PhD who don't even know how to pronounce it. It's Keynes and Keynesianism. Okay, Keynesian economics. All right, say that a few times because otherwise it's going to be embarrassing. There are two main tools in fiscal policy: government spending and taxation. And there are two main goals. One of them is to get rid of unemployment. The other one is inflation. So those are the two evils that we have. Now think of this. If the government wants to get rid of unemployment, it means that they want to stimulate the economy. Now, how do you stimulate the economy through spending? Should you spend more or less? You provide a stimulus by spending more. All right. What about taxes? How do you stimulate the economy through taxes? Do you have to tax more or less? In this case, you have to tax less. And the logic here is, first of all, when you have these things, in order to analyze them, you have to write your formula for aggregate expenditure. So that helps you a lot. If G goes up, well, G goes up, therefore aggregate expenditure goes up. And if T goes down, what happens if T goes down? Well, the households and firms will spend less. Remember disposable income? They're going to have more disposable income, therefore they can consume more and invest more. All right. So because these items go up, aggregate expenditure goes up and GDP goes up. Whenever GDP is higher, it means there's more demand for workers. So there's going to be more jobs available. All right. So that's how they stimulate the economy. All right. For the inflation, it's going to be the exact opposite, right? Either spend less or tax more. Again, taxation would go through disposable income. So government spending goes down, and because disposable income is less, then the consumers and businesses are going to spend less. And because of that, there's going to be less production, and that is going to deflate the prices. All right. So the first one is called expansionary policy. So expansionary fiscal policy is used to combat unemployment. It's called expansionary because GDP goes up. So the determining factor is GDP. The second one is called contractionary because GDP goes down. Pause here, take notes. It's quite common to turn to the government to solve our problems, but government solutions often defeat their purpose and they create additional problems. So the idea that the government is our savior and pushing for more government intervention is ultimately a fallacy. So fiscal policy is really a fiscal fallacy. Now, the argument of fiscal policy is that the government projects inject money in the economy and that helps us grow and have greater well-being. But then as economist, your first reaction to any proposed solution should be, at what expense? Now, where does the government money come from? How do they fund those projects? Well, primarily taxation, right? If they don't want to tax, there are other alternatives to borrow, all right? Well, what happens if they borrow money? When they borrow money, it means that they have to pay it back later with interest. Now, how do they pay it back later? Well, with future taxes, right? So ultimately, we are back to square one. Ultimately, there is only one source for government revenue, okay, which is taxation. Now, what that means is that, oh, that's so cool. Any government spending is the same as taxation. So any kind of government project, on one side of it, it says spending, on the other side says taxation. That's effectively what's happening. That was a great discovery of David Ricardo, one of the founders of economics, which is called Ricardian equivalence. And people take this into consideration. Financial markets react in anticipation. Whenever they see the government getting bigger, they realize that, oh, you know what's coming up? Higher taxes, sooner or later, all right? So fiscal stimuli don't stimulate more spending because people's permanent income is unaffected. This was the great contribution of Milton Friedman. You saw the idea of permanent income. What determines people's behavior is not little injections here and there. It is a permanent income. The COVID stimulus was a very good example that people's spending didn't actually increase. Why? Because they were thinking in long term, and their permanent income was not affected. Maybe it was even lower. All right. So what happens? Let's look at let's unpack this. What happens if there are higher taxes? You have to think of households. What happens to the households? If they tax the households, you have to think of the disposable income, right? So disposable income goes down, therefore consumption goes down. If they tax firms, what happens to them? Their incentive to invest is going to be less, therefore investment goes down. And you have your AE formula again, right? So you have to put that in, and you have to look at the arrows. So you have the I and C going down. As a result, whenever the taxes go up, aggregate expenditure goes down, therefore GDP goes down, and there will be less demand for workers. So when there's less demand for workers, there will be more unemployment. That's how government spending actually defeats its purpose, all right? And another very important concept here is crowding out effect. So the government gets bigger and bigger and bigger at the expense of the private sector, which are the households and firms. All right, it's kind of like this. When you have, you could have a big government with a big flower, but it also means that the households and the firms are going to be smaller. They get a smaller share. If you remove the government, it doesn't mean that this flower stays as small as it is. This one actually gets to grow, gets to breathe. Okay, so what I emphasize here is that the importance of taxing as a source of government revenue, and what is the meaning of crowding out effect. Did you see that? It shattered. Another problem with fiscal policy is that historical evidence is against its effectiveness. A prime example of that is the FDR's New Deal during the Great Depression, such as the Hoover Dam on Colorado River. And none of that actually pulled the economy out of the depression. Why? Because of the crowding out effect. The Western countries came out of the Great Depression because of the Second World War, which inspired a lot of hope, and there was a state of emergency to move it. All right. Another example of that is Barack Obama's Recovery Act after the Great Recession, such as this was the Solana generating station in Arizona, which received $2 billion of subsidies from the government. Among other projects, the government specially funded a lot of solar power projects, and they funneled like billions of dollars into that. Some of these companies simply went bankrupt without producing a single watt of electricity because they were just funded by the government instead of being competitive. Another example is, of course, the COVID stimulus. Again, the government injecting a lot of money without helping the economy get out of recession, but rather creating inflation on top of that. All right, and it's interesting. Every time there is a failure in government policy, their answer is only if we had more funding. All right, so it's not they don't learn from their mistake. They don't realize that this is not the way. They just ask for more money so that they can dig themselves deeper into the hole they're in. Creating jobs isn't hard. Have some people dig holes and others fill them. To be fair to Keynes, we must read this quote in its context. He was criticizing a gold mining frenzy during the Great Depression. Or break a window. It creates a job for those who have to replace it. The question is, at what expense, and what else can we do? That's the essence of fiscal policy, which is called the broken window fallacy, proposed by a brilliant French economist, Frédéric Bastiat. Now, instead of replacing the window, we could use our resources to do something more innovating. It's also a fallacy to push for having jobs without asking about the nature of those jobs. Keynes had some of these ideas, which are still very popular today. This is the largest boneyard in Tucson, Arizona. These are old military aircrafts which have no use since there's no new technology. They are left here to be recycled, which has its own costs, or simply destroyed in most cases, which is also costly. Military spending becomes a vicious cycle because one side does it and the others have the incentive to keep up. It's a self-fulfilling rat race. And all sides end up wasting resources which could have been used in more constructive ways. If they use these crafts, it's destructive. If they don't, they have to demolish them. All right. 12% of taxes in the US go into the military. In Canada, it's 8% of our taxes, which is still a lot given the size of our army and our needs. Right? That is called military Keynesianism. And we're spending over $20 billion of taxpayers' money in Canada for that. Don't we have a better use for that money? Now you can see how there is a lack of accountability in government decisions since they don't have competitors. That's the advantage of a market solution to a government solution. Interestingly, Germany and Japan had restricted army spending after the Second World War, which actually ended up being a blessing for them. As an economist, you should be very sensitive about opportunity cost. There is no free lunch. There are no magical shortcuts. Whenever we have a greater government, we are making a lot of compromises. You also have to think about the incentives. More government spending results in less private sector spending. There are also a bunch of lags here. It takes at least 2 quarters, half a year, before our data can reveal a problem. And after that, there is a legislative lag before the parliament arrives at a policy. And then it takes even more time before the new policy is put in place, kicks in, and gives results. By the time its effects appear, we are likely way past the initial crisis, and the policy only distorts the economy further. It's kind of like giving medicine to somebody who has already recovered. That would be poison to them. All right. So there is also the problem of favoring others, favoring those who already have the power. So the alternative is hands off. That would be a better fiscal policy, because then you are avoiding a whole bunch of problems. All right. Now, something I want to clarify is that we don't have any ideal utopia. When we say hands off, it doesn't mean that it is going to solve all of our problems. There will still be imperfections. But relatively speaking, it's a better contribution by the government than direct intervention and an ever-growing government at the expense of individual liberty and market efficiency. So with this thing, we can have a greater confidence in the private sector so that they can adjust to the market conditions. The business cycle consists of fluctuating recessions and expansions. If the recession is severe or long, we get a depression, and in any recession, there are grounds for creative destruction. It doesn't have to be a depression for this one, so it could go from recession, and that's going to be a form of business investment. Expansions, in some cases, could lead to financial bubbles through speculation or confidence, and confidence is really the core of saving, which is a form of wealth. Then we have fiscal policy, which is meant to respond to business cycle and mitigate it, lower it, reduce it. And the main tools for that are government spending and taxes and transfers. But it leads to policy lags, crowding out effect, and rent seeking because of the Ricardian equivalence and the permanent income. And I would emphasize the concept of fiscal policy, of course, as well as recession. So pause here, do your own neat concept map. This is a little bit messy because I had little space. Try to include disposable income also. That's a very important concept. How would you improve your answer to the myth of the day based on what you learned in this lesson? Take a minute and improve your answer right now. As a counterexample, you can think of Nokia, if you've heard of it. It was a world-leading cell phone brand until the late 2000s, but it couldn't keep up with more innovative and efficient brands. Not BlackBerry though, oh no. And the US government especially spent billions of dollars bailing out these big corporations. This was a very popular myth after the 2008 recession, because many people lose their jobs when big guys go bankrupt. In terms of arguments, you can think of creative destruction and the idea of recession. You have to think about incentives, which is super important. And at the end of the day, there are no solutions, but only trade-offs, especially between the short run and the long run. If a company has something of value to offer to people, then it will survive. Otherwise, why should we insist on maintaining it at the expense of taxpayers' and other new initiatives which would arise in the absence of the old one. By the way, here's a little rhyme for you. Have a great day.